Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, October the 24th, 2025. Okay, so let's immediately see what's going on today. Everyone's very, very excited today because we have some real data finally, some tier one data. So we have for the September period, the CPI. So let's have a quick look. This is just a roundup of various sort of banks, just to get a sense of what's going on. The headline number, of course, we'll look at, but really it's the core. And you can see that for the year over year, we've got, basically about 3 to 3.2, 3 to 3.2. The median seems to be 3.1. And then for the month over month number, which is probably the most important number, 0.3 is the median. And keep in mind that previous month was 0.35. Having said that, we are expecting for the headline number a slightly higher number, 0.39. But if we look at the range of forecasts, you can see here that there are some which are a bit higher, 0.36 from Barclays. What's the low one here? We've got a 25 here from Bank of America. But basically, we're looking, something around about late, sort of 28, 29 basis points, 30 basis points, something like that. Okay, so let's now just go and look on the Bloomberg and just see what some other information which we can dig up here. Sorry, that's oil. We'll look at that in a second. So of course, the thing is today that, as we say, we've got the CPI, but we also have at 9:45, we have some surveys. We have the S&P Global, so not the ISM manufacturing, but we have the S&P Global PMIs, which is quite interesting because they do that all over sort of every single country that do it globally. So we have the manufacturing, the services, and of course the composite. So manufacturing is expected to stay in expansionary territory above 52. The services again above 50, which is indicating expansionary sort of confidence, even though it's down a little bit. So overall, a relatively solid sort of PMIs are expected. We also get at 10 o'clock, we get University of Michigan. This is the final number, so it's the second read for October. I don't know how important that'll be. Maybe just, in terms of the inflation number to confirm or negate what we get in the earlier sort of CPI numbers. But the reality is that recently University of Michigan seems to be a very bifurcated kind of response, depending on whether one is has allegiance to the Republicans or the Democrats. So I'm not sure the market will really look at that too much. So getting back to the CPI, as we just saw from the list of the various banks, just according to the Bloomberg surveys here and the consensus, if we look at the core month over month, now they're going for 0.4, which is interesting on the Bloomberg, so a little bit higher than what we saw on those other banks here. And the headline number is sorry the core, sorry, 0.3 is the core. My mistake. The 0.38, the 0.4 is for the non-core, so the headline number, and then 3.1 overall. So obviously what we know is that 3.1, both on the core year over year and the headline numbers, is A, it's possibly going to be a little bit more than last time, and B, this is well above the Fed's supposed 2% inflation rate. So let's just have a look and see what's going on with the Fed here. Before we get back to those numbers. And as you can see here, that we've got 24 basis points out of 25 of cuts priced for the upcoming October meeting on 29th, basically only 5 days away now. So that's fully baked into the CPI and then also into the market. And then if we look at December, we've got another cut almost priced. So not exactly at 50 basis points, but we've got 47 basis points as we speak. So that's essentially, almost two cuts. So 1.88, 1.9 cuts, two cuts priced in. And then as we go out throughout the year, we can see that we get down all the way down to about sort of 4.5 cuts priced by the end of 2026 going to 2027. So the question is, and we can see that that's changed a little bit. This is just looking here at the December pricing. This is a tick chart, so very, very short term. Each little section here represents a day. So if we go back 5 or 6 or 7 days, we can see that the market, did get down to just where there were some worries about, some of the banking sort of liquidity and whatnot, some of those regional banks, we did get down to about 56 basis points, 55, 56 basis points. So, just on the dovish side of two cuts by December. Again, this is for December pricing. But as you can see, the market settled back in, around about 50. So this is the 50 level here. You can see that we're essentially either side of that, 47, 48, 51, 52. The market is basically saying the Fed's going to cut next Wednesday, and then it's going to cut in December. So the question is, can anything today happen which will which will sort of change that. I don't know. So if we go back and just sort of see, let's just again just look at what could change the market pricing. And again, so I'm going to go on the core CPI month over month. Let's just look at the economist estimates. And again, we just looked at a few of those from the banks, but just looking at the Bloomberg survey, which has slightly different ones here, we can see that again the low is for 0.2, the high is 0.4. And keep in mind these are rounded numbers, so it is going to be interesting to look at the unrounded number. Because the point is, even though the median estimate is for 0.3, if we get 0.34, that'll be 0.3. But if we get 0.26, that will be rounded up to 0.3. So there's a difference between 0.26 and 0.34. That's almost 8/10 difference, but it will give us the same number. So it's kind of interesting just to see what the unrounded number is here. And again, you look at the standard deviation here, it's a 0.04. So keep that in mind. This is the standard deviations here. So it would have to be essentially probably, zero point 0.4 or 0.2 would start to get the market's attention. But really, it would have to be something very, very dramatic to sort of upset the market. And the question is here, what would happen? I mean, if we get an inline number, the market, I don't think will react in terms of the bond market react enormously just because that's fully priced in. What it could do is to confirm that inflation is stable, and so the long end, which has been doing quite well, could get a little bit more of a bid, a bit more in duration. The front end, I don't think will move too much. Of course, if we get a dramatically lower number, I don't know, what would that be? 0.1, for example, on both of them. That could get the front end of the curve moving lower in yield or higher in price, because at that point we might get pricing, starting to price in not just 25 basis points, but who knows, maybe even the chance of a 50. But again, I think that's a low probability, because the reality is that the tariffs are having some effect. Prices are kind of quite sticky. So are they sticky enough to keep the Fed from cutting? Probably not. So I think that the reactions today are going to be fairly sort of classical in a sense. If we get an inline number, I think that's going to be relatively good for the belly or the long end of the curve, probably quite good for gold. The US dollar will probably come off a little bit. And I think equities will actually like that. Equities, as we know, are at highs. But I think equities will like an inline number, just because that will give the all clear in a sense that the Fed will cut once, if not twice, this year, as the market is pricing in. And at that point, we've had reasonably good earnings at this point. So I think the equities could push to a new high. What happens if we get a very soft number? I think obviously the front end of the curve would like that, so we could get the ZT going up, the STIRS, and I think even a bit more than the back end of the curve. So we'd probably get a front end led sort of bull steepener at that point, as the front end yields come down a bit more than the back end, which is always keeping an eye on inflation. If we get a soft number, I think that's not great for the US dollar. Again, if the number is relatively soft, I think that's also a positive for equities. So what happens if we get a hot number? What would a hot number look like? A hot number possibly could be, something like, 0.4, obviously 0.5, something like that would get the market's attention. I think equities would definitely go down on that. The front end of the curve would probably maybe not price out the 25 basis points, but it could just, just for the fun of it, in a sense, go down to 3, 4, 5, 6 basis points. Would that be bought back? Probably. And I think the long end of the curve would not like that. So we might get a bit more of a sell-off on the long end on a hot number. I think the US dollar might have a quick pop, and gold would probably fall a little bit on that. So obviously the hot number is less market friendly in a sense, but at this point it would have to be something quite substantial to change market pricing. In terms of what the Fed is doing. And keep in mind that the Fed, of course, is in a blackout period. So they would have to sort of, feed some story to Nikki Leaks or something like that to sort of, if they were thinking about not cutting in next week. And I think that's very doubtful. Probably what's going to get more of the market's attention, we have upcoming meetings in China, obviously with Trump and President Xi of China next Thursday. But in the meantime, I think even starting this weekend in Malaysia, we have Secretary Treasury Besant. So really what the market wants to look at, just looking at a few charts here, is, are we going to get, at some point, some kind of sort of diminution of the tension with all this sort of rhetoric around about trades? We can see that, for example, the SPX here at highs, we see NASDAQ on the cash also along highs. the Russell not doing quite as well, but still essentially, almost at highs here. So the market is doing quite well, but really in order to push higher, we are getting a bit of consolidation and sort of grinding price action here. In order to push higher, the market really wants to see that there is some way forward to, as I say, to cool down the inflamed rhetoric between China and the US. And Trump has talked about trying to get a total deal, a comprehensive deal. I don't know if that's going to happen because the Chinese are sort of going to be, why would they roll over? There's no reason for them to roll over. But maybe we'll get some kind of negotiation. If that's relatively positive, I think equities, they're getting a Fed cut next Wednesday, maybe some trade sort of negotiations going on. That could be the signal for equities to move higher. Um, Right. The other thing as well, of course, is next week we get earnings. We get a lot of the big tech companies. So, next week is going to be the next 4, 5, 6 days. We've been in a bit of the doldrums here, but the next few days will definitely get everything moving. If we look into something like oil, just keeping an eye on oil because we know that we had the sanctions. You can see oil continues to push up, and this is quite a critical level. I'll put on a 4-hour chart here, and essentially, if you look at this Fibonacci, which is this sort of orange line here. This is the fib retracement from this move here. I'll just make that a little bit more accurate. As you can see, we'll put it there. And you can see here that the market has this is a very key level. You see there's horizontal resistance here. The market tested it once or twice, came back up there, came down and pushing up. So this is actually quite positive price action here. And it looks as though it wants to break out. If it does break out, you've got to say the next sort of target on the upside is 65.20 or so. And that's just because these sanctions are quite serious. We're talking about 5% of the world's oil supply. Now, obviously, that's not going to be blocked, but it does seem that, a lot of refiners, especially in India, but the Chinese as well, they're starting to sort of, cancel orders for Russian oil. And essentially that it's going to make life a lot more complicated if, anyone doing business with those two sanctioned companies in Russia, if they do business with them, they're going to be cut out of the US sort of banking and the US dollar system, which does make companies pause, of course. And so just in the meantime, it does seem as though it's going to be complicated for oil and that there will be less Russian oil flowing. And that's just putting up the price. And as you can see, the price action is quite constructive just on this 4-hour chart. That looks as though it's moving up. And we can actually see that if we look at the time spreads. I'll just grab some tea here. There we go. So I think I showed you this yesterday. And basically what we have here, this is the spread between the front contract CL1 for immediate delivery and CL6, which is 6 months down the road. This is a 60-minute chart, so it's not a daily chart, a 60-minute chart. But what you can see here, these two things here are the actual prices. And you can see here the prices, they move together. But what you can see is that the white one, which is the CL1, so the front contract, you can see that has you see how they're very, very closely tied, but you can see how it's outstripping the CL6, which is the orange one. And you see the spread here, which actually was into a contango. At the start of this, when we got this information about the sanctions, you can see that this push higher and higher, and it's actually at a new high of $1.92. So I think yesterday that just sort of cooled off a little bit, but now at $1.93 here. So that spread is pushing higher, and that means that customers are essentially happy to pay a premium for immediate delivery, signaling tightness at the front of the curve, which is basically bullish for oil. So the point is that the curve here is not the curve here, but the time spread here, CL1, CL6, is quite bullish for oil. And if we just go back and look at that daily chart, we can also see that seems to be reflected. So that's also going to probably be reflected if you look at the gasoline, which is also pushing higher. Not so much for nat gas, of course. That's got a different set of factors about U.S. weather. We had just put that back on the daily. We had a weather forecast for cold weather last weekend, about 4 or 5 days ago. Subsequently, that's I don't want to say cooled off a little bit, but that's sort of dissipated a little bit. And you can see we got to the top of the trading range, so nat gas down. But the point is here as well is that with these higher energy prices and maybe sticky inflation, which we might get a sense here today of running about 3% annualized, this also is putting a little bit of pressures on the bond market, especially the back end of the curve. You see here, in order for this back end of the curve to push up, we're going to have to see probably inflation not getting worse, and possibly even sort of oil prices coming down, because the bond market does not like energy prices being elevated, and that's and obviously long bonds, their purchasing power of your yield gets eaten into over 30 years by inflation. So that's why I think some of these long bonds are coming off. So it'd be interesting if they do get down to a more attractive entry level. Apart from that, we have the dollar index overnight. Again, not a massive move. We're talking 15 basis points here, so 0.15%. Not a massive move, but it is grinding higher, so pushing down on the euro just 8 basis points. We can also see if we look at the Japanese yen, down about 20 basis points or so. So the dollar just is sort of grinding higher. The dollar at a certain point will benefit from higher oil prices as well. I mean, keep in mind that in contrast to the old days, 20, 30 years ago, the US is now a net exporter of oil. And so if oil is going up in price, but especially if it gets up into the late 60s, into the 70s, that will put a bit of upward pressure on the dollar, because, as I say, the US is a net exporter of oil. So if oil is going up, that's going to have more income coming in and be better for the US dollar. So as I say, but a lot of this now is all going to be determined by what happens in the CPI, but also I would say the PMIs. Keep an eye on the PMIs, because we really want to try and get a sense of what sort of purchasing managers are thinking about the future. How is how's the real economy going? And then finally, let's just have a look at some of these metals. Gold seems to have had a bit of a dump. That's interesting. It got to just it was like a sort of a bear flag kind of a situation here. If you look on let's say we'll put it on the 15-minute chart or something like that, you can see that we did get sort of a bit of a sort of a flagging formation here. The same thing here for silver has come off quite a lot. If we get to silver, there's silver's come off, but you see that copper has come off. Just wait till it loads up here. Copper has come off, but not nearly as much. You see copper hanging in there. And I think that's, as I mentioned yesterday, there were some questions about some lower production at some of the world's major copper mines, but also the fact that there is a little bit of guarded optimism that China and the US will hopefully be able to talk their way through negotiations and set the stage for maybe more clarity on global trade and less tariffs and whatnot, which would be a benefit for copper overall. Okay, guys, I'm going to leave it there. Get prepared for CPI. So have a great weekend, have a great day, and we'll continue this macro snapshot next week. Thanks very much. Have a great day.